Caitlin Long is the founder and CEO of Custodia Bank, which provides payments, rails, and custody for digital assets. In today's podcast, we explore the recent surge of institutional interest in crypto, regulatory pressure in the US, and whether US regulators are prioritizing investor protection or incumbent interest. But first, we start by delving into Caitlin's journey as an early adopter of blockchain tech.
I came across Bitcoin in 2012, really dug into it in 2013, and I was, at the time, a managing director at Morgan Stanley in New York, running the pension solutions business. So I had to keep my head down back then. You couldn't pop your head up and admit you were a Bitcoiner on Wall Street. It's so funny how I'm watching these big institutions come in now. I knew eventually they'd get there. It's just a question of how fast. And now here we are. And then Custodia is a Wyoming special purpose depository institution that is designed to very thoughtfully, safely, and soundly bridge between these two ecosystems in a way in which neither hurts the other. And unfortunately, what we've seen in this past year is that both has hurt the other side. We've seen some of the crypto fast withdrawal issues come up with a couple of the bank failures. And frankly, the bank failures have hurt. And the fact that the banks didn't do it would appear, their AML KYC on some of the scammy crypto exchanges very well, that they hurt the industry as well. I will say, though, for a lot of that part of the industry that's gone, good riddance. The vast majority of the industry, I think, probably still is a problem. And frankly, we really just want legitimate, law-abiding, property rights respecting, customer asset respecting, consumer protecting, anti-fraud, anti-money laundering businesses in the industry. All that said, though, I also am very, very concerned about some of the things that have happened in the last 2 business days, today and Friday, before the long weekend, that would seem to reveal that there is an incredible incumbency bias in Washington, D.C., and they want to shove out all of the law-abiding startups and let the incumbents catch up, unfortunately.
Let's dive right into that, into kind of what is on your mind right now. Like, what are those concerns stemming from?
Well, there's banking concerns, and then there's SEC securities concerns. And the news that came out in the Wall Street Journal article today about a number of very large Wall Street trading firms creating a Bitcoin exchange with some of the biggest names on Wall Street is so interesting. And you have to view it in the light of what the SEC has done, moving against the other crypto exchanges, including most recently Coinbase. And so why is it? It sure appears that there's an incumbency bias from that perspective. Somebody asked me about it, the ETF that BlackRock has registered for. If that one is the one that breaks through, boy, will you have a lot of people in the across the entire spectrum of the crypto industry, but far beyond the crypto industry, standing up and screaming, saying, what the heck? The Democratic Party's in control in Washington right now. It says that it doesn't want to make big financial institutions bigger, but it's trying to seemingly hand them, some of the banks that have failed, right? They went to some of the biggest banks whose stock prices went up on the announcement, and now look at digital asset exchange, and then also on the banking side, we saw it with the release of the Fed's master account database, which they released late on a Friday before a 3-day weekend, which you tend to do when you try to hide something. And it does look like there is a reason to hide. The Fed fought the disclosure of this for years, and it was Senator Pat Toomey of Pennsylvania who got it into the NDAA, the National Defense Authorization Act, in December of 2022, that the Fed is going to have to disclose who has accounts at the Fed. Accounts at the Fed are highly coveted because they allow the account holder to bank directly at the Fed and not have to go through a commercial bank. So in some cases, it's going to be saving businesses tens of millions of dollars in cost, but almost more importantly, there's no counterparty risk when you face the Fed directly, whereas everything above $250,000 deposited in a commercial bank does have counterparty risk, right? So everybody, if they could, would face the central bank directly. But the Fed has been clearly inconsistent, arbitrary, and capricious in how they've been giving access to these Fed master accounts across the board. And this is so much bigger than just the crypto companies like Custodia that have applied. There are 414 uninsured companies, entities that have Fed master accounts, of which the vast majority do not have a federal regulator. And when the Fed denied Custodia, those were two things that it pointed to. So there is a lot of inconsistency, double standards, incumbency bias, and non-adherence to the law. And it all is just coming out in the last couple of days.
This is so interesting. So let's kind of step back and maybe I'll provide a little bit of context on a couple of the news that came out. So I think today the exchange that is backed by Citadel, Fidelity, Charles Schwab went live. And as Caitlin was pointing out, this is just, a week after this SEC lawsuit against Coinbase came out. So if you put those two together, Caitlin, it looks like you're saying the regulator is looking to back the incumbents and go against the newcomers, like the crypto industry in this case with Coinbase.
I think your dog seems to agree to it. Agree with
you. It's always at the best time, Conga. Yeah, she's very excited. And then at the same time, BlackRock filed for a Bitcoin ETF, though I've seen some discussion whether this is actually an ETF or a trust, but in any case, it's an exchange product that holds Bitcoin and provides access to Bitcoin to institutions and just retail investors who just want to, buy this fund. So whether it's an ETF or not, I guess like the point is BlackRock has filed for this product, and if you've been in this space, you've been hearing about a Bitcoin ETF forever. I think 2013 was probably the first time that the Winklevoss twins filed for one. That was denied, of course, and every other application has been denied since.
Denied or expired. Right, and at this point, it's probably 24 applicants, right? So when the 10-ton gorilla in asset management comes in, if all of a sudden, it's great that they came in. I've been saying really since 2018, I wrote a number of pieces about ETFs in Forbes, that was going to be a double-edged sword. I am not as excited about this as most of certainly the Bitcoin traders are excited, because they look at it and say, well, gee, liquidity is going to go up. That means bid offer spreads are going to come down. And that's true. But I would say on the flip side, it increases the probability that you get shenanigans that suppress the price. And that's what happens in most of these Wall Street products, where the ledger systems can create phantom shares. And go read the fine details of the plan of distribution for any ETF. You're going to find that the market makers have the ability to issue more fund units than they have collateral on their balance sheet. Okay, so that basically creates some fake supply, and they do that to keep continuous markets. But again, this is one of those fudge factor things. I've talked about how the fact that the Wall Street systems are not in sync with each other, the SEC has allowed companies like broker-dealers or like market makers in an ETF to have some fault tolerance in the system, so that it takes into account the fact that it takes a while to settle transactions. And so they're going to allow a market maker to go naked short, is another word for it, some more units than there is actual collateral backing them up. And that's the kind of stuff that I've been warning against for years. And so here it comes with the 10-ton gorilla, of Wall Street. So very much a double-edged sword. But there's a bigger story. That's generally an issue that I would have with ETFs. The bigger story is, okay, what's really going on here? All of a sudden, we've got these big Wall Street firms that are coming into crypto right after, the runway's been cleared, so to speak, of all of the startups, including the most successful one, Coinbase. As an attempt to shove everybody to the side. Now, I'm not defending everything that this industry has done. In fact, as I will reiterate, the vast majority of it needs to burn on a raging funeral pyre. There's so much crap in this industry, but there is also a lot that's legit, and it gets lost in the shuffle. And unfortunately, those who have actually tried to comply with the law have been shoved aside as well. And when we look at the Fed master account database and see the double standards and see the incumbency bias, wow.
So can you get into this this Fed master account banking? I'm sorry, I'm not up to date on this specific news item, and it's super interesting. So what you're saying is that Custodia and other crypto operations have applied to bank directly with the Fed. And of course, this is super beneficial because it's cheaper. You don't have to go through intermediaries. You don't have counterparty risk. I mean, I think, everyone would want to do that.
Correct.
And so you were denied. Apparently, other crypto companies were denied. And it looks like now that it's been disclosed, the companies that were approved to bank directly with the Fed, you're seeing some inconsistencies, and that things that you were told it's why you're getting denied. You're seeing the same rules aren't being applied to the institutions that are actually approved.
Correct, but this is so much bigger than just crypto. It's not just the crypto companies that were disparately treated. By the way, there was one that the Fed let in. Why the one, and why the different standards versus the other?
Which one?
I'm not going to drop names. I'm very careful not to drop names because this is let's put it this way: the fight over Fed master accounts is a major fight, this is the issue. When companies get the Fed master account, they have a structural advantage. And when you start and look and realize that there are incumbents on that list that have probably ineligible master accounts, but the startups are being blocked, the startups that are clearly eligible, but there are incumbents that are ineligible. So it goes well beyond just crypto. I'm not talking about just crypto startups. I'm talking about financial technology companies as a whole who have tried to get master accounts, right? So the fights are nasty. Not naming names here, but you're starting to see it trickle out. I wasn't the only one who was buried deeply for hours every day over the long term, over the 3-day weekend in this database, looking at some of these things. And I'll give you another one that's not controversial. Well, I mean, it probably is controversial, but it's a name that I can say. The state treasurer of Texas has a Fed master account. And if I'm the state treasurers of the other states, I look at that and say, why don't I get one too? Right? And what's really going on? I mean, that's one of those questions that should be asked. Frankly, if I were the Texas bankers, I'd be pretty upset. Heck, one of the biggest actually the biggest bank in the United States just moved into the state of Wyoming because they wanted to get the state's business. Okay, so the local banks here in Wyoming are not happy about that because here comes the biggest bank moving into Wyoming. Again, I'm not talking about crypto at all. I'm just talking about state business, right? And then you realize that one of the state's treasurers has a master account. If I'm the banks in that state, that they got circumvented. I'm not very happy about that. But by the same token, if I'm the other 49 state treasurers, I look at that and say, what's so special about that state? Why didn't I get one, right? So I think there's going to be a huge brouhaha over all this, and it's going to be developing in the coming weeks and months. When you start to realize how arbitrary this all is and how inconsistent, and frankly, again, it so favors incumbents. It's incredible.
Parcel, the decentralized real estate trading platform is making it easier to get exposure to global real estate. Through city indices, you can trade the price change of popular US cities and easily access over 5 million properties with just a few clicks. With leverage up to 10x, you can go long or short and begin trading real estate in ways you never have before. Join today to start building a diversified real estate portfolio. There's been this recurring question when covering the SEC and other regulatory action in the US against crypto. And the question I keep hearing from everyone is why? Like, what's the motive, specifically from Gary Gensler, to be so opposed to letting this new industry flourish, when you would think it's in the US best interest to have innovation and new business come to this country in the way that it has fostered new technology before. And so there's just been, a lot of speculation on kind of the motive for this. And, I've heard different theories, but from your side, there's a new theory, which is, it sounds very likely to me, which is just current regulators are looking to protect incumbents. Do you think that's what's driving the recent regulatory action?
Well, again, watch what they say, not what they do. Look what they've done. It certainly has attempted to sideline all the startups. Again, many of them deserve to be sidelined. I'm not defending. This is not black and white. But they also sidelined the ones that were 100% compliant while they're green lighting. So in Custodia's case, Bank of New York Mellon is a bank that's doing exactly what Custodia proposed to do, Bitcoin and Ether custody. So we have literally in the proposal, the second proposal that we had to the Fed, which the Fed voted down, was plain old boring old FedWire and ACH, and then Bitcoin and ETH custody. That's exactly what Bank of New York is already doing. And yet Custodia was voted down and Bank of New York is skating. So, I mean, you tell me. Look at the facts. It's not difficult to draw the inference from the facts. And I'm starting to see some of the same things happening on the securities side. To your point, though, I'll take the regulators at their word that they want law-abiding, regulatory compliant companies in this sector. The problem is that they're closing the door, slamming the door, and disparaging even those of us who are in that category. So I don't disagree with them that they want law-abiding, regulatory compliant companies in this sector. Absolutely not. It's anything that I would disagree with. The hardcore purists probably would, but I don't disagree with that. The problem is that what is essentially being laid out is that it's all that the red carpet does seem to be rolled out for the incumbents. And it's the good old boys club proverbially. It's
so frustrating, and not only it looks like the companies trying to do things by the book are being shut down, but even just like smaller crypto startups that are trying to comply aren't being, they're not able to. So Gary Gensler keeps saying, come register, our doors are open. We have clear regulations for everyone to follow, but nobody's able to. And as someone who has been on kind of that side, how does that look for you?
Well, yeah, I mean, the SEC thing, I'm watching all that from the sidelines because it doesn't affect Custodia. Custodia is a bank, and banks have lots of powers under the Dodd-Frank Act if in the securities industry, where banks have special exemptions from the requirements to register as a broker-dealer. They're not relevant for what we're talking about here. But for example, one of the things that does come up is if a particular crypto like ETH is a security, well, a bank as a custodian is authorized to provide custody services for securities. So that distinction wouldn't matter in the same way that it would for an exchange. So I went down the rabbit hole a little bit here, but you start to see how subtle these things become. But I look at the SEC situation and look, again, I've been very supportive of the SEC in the face of criticism from crypto Twitter for calling him as I see him. You can go, search crypto Twitter and you'll see where the SEC has done things right. And even though they might not be popular, I think the SEC did its job. But there's also a lot that the SEC has done that's outside of its jurisdiction and I think is not likely to withstand scrutiny. And it'll be interesting to see how the lawsuit, both the Grayscale lawsuit and in particular the XRP lawsuit. The XRP lawsuit, we're getting into the landing zone of when that opinion is going to be coming down. And I don't know I'm certainly no expert in that case or in XRP or in the securities law, indeed. And again, I'm not a practicing lawyer, so I just have some legal training. But the way I think about it is, boy, if the SEC loses that case and XRP is not deemed to be a security, then they lost a lot of jurisdiction. Because if XRP isn't a security, then, a lot of the other things they're alleging are securities may not be. So I'm just watching this from the sidelines, grabbing popcorn and saying, all right, this is really a jurisdictional fight. And the SEC is trying to grab jurisdiction over things that there are legitimate arguments on both sides for a lot of these cryptos. I'm not going to name them, but there are legitimate arguments on both sides as to whether they are or are not a security, which is why we have all this ambiguity. And here we are, 15 years into it almost, and we have all this ambiguity, and it's crazy. But it's all going to be litigated, I think, in court. It doesn't look like Congress is going to step in and define which cryptos are securities and which are not.
We'll just have to be patient and see which way these lawsuits go. Acmetrics is a decentralized non-custodial protocol for asymmetric yields distribution generated from staking. This is how it works. Users deposit their STETH to a common pool. Then this pool accumulates staking rewards during 7 days and distributes them to 3 users only. The users can earn huge staking rewards without risk for initial deposit. So this is how you can add fun to routine ETH staking. So with all these big financial institutions still coming into crypto, even in the face of what prices have done and the regulatory environment, I agree that it's a shame that it's not kind of crypto native companies that are doing this, but it also seems like this should be a plus for the industry as a whole. I mean, what do you think will be the consequence of having this, these big institutions come?
Well, just like I wrote in Forbes back in 2018 about the ETFs, it's a double-edged sword. And back then it was Backed, which is a sister company to the New York Stock Exchange, part of the ICE, the Intercontinental Exchange. Umbrella of companies. That was what I was worried. They were going to come in and start doing leverage-based financialization of Bitcoin. That's why this is a double-edged sword, because frankly, no one should ever lever Bitcoin more than 1-to-1. Because the moment somebody does, that means somebody's insolvent. And nobody's making any more than 21 million Bitcoin. And if you start commingling that kind of exposure with traditional financial exposures, I was frankly worried that there would be a big leverage unwind for Bitcoin and it would take down a clearinghouse because it's all commingled, right? And so if somebody says, well, I've got a post margin on Bitcoin, but I'm going to post you dollars as margin, or I'm going to, post you oil collateral, or, other forms of collateral as collateral other than Bitcoin. That's when when a clearinghouse can go short Bitcoin, right? And so to me, the whole concept of commingling, allowing commingling of collateral and collateral substitution is exactly the kind of thing that puts these institutions at risk from a solvency perspective. And I don't want those institutions going bust and bringing down the banks. And now we've got some of the largest financial institutions in the world coming in and bringing these leverage-based financialization games. How do you think they got so big? How do you think they got so rich? One of the ways that they did it was the roll the dice if heads I win, or rather flip the coin, heads I win, tails the taxpayer gets handed the losses, right? Okay, that's not ethical. That's not fair, and yet it's the way traditional finance works. Why? Because there's a lender of last resort. There's a clearinghouse. Somebody who gets in trouble can go get liquidity, which is really papering over a solvency problem in almost all cases, from a central bank or from a clearinghouse. And frankly, there won't be a clearinghouse. I read today in the Wall Street Journal article that EDX is looking at putting a clearinghouse together. Good luck. It's a paper clearinghouse, right? So there have been a lot of allegations over the years about the ETFs in gold and the other trusts in gold, essentially creating 100-to-1 paper gold exposure, and even more in the silver markets at various times. Well, Bitcoin's not there yet. There's definitely a lot more paper claims to Bitcoin out there than there are actual Bitcoins. Because, I mean, we know it, right? FTX was taking money that people thought they were paying for Bitcoin, and they weren't buying Bitcoin on their balance sheet with it. And a lot of these other leverage players like BlockFi that were rehypothecating, they're all defunct now. That's going to happen to these big Wall Street firms too at some point. So that, that's the problem with commingling them with the traditional banking industry. I don't want Bitcoin to let's put it this way. I don't want leveraged Bitcoin to infect the traditional financial industry. And yet it does seem that, unfortunately, the financial regulators don't understand this, and they prefer to have the big balance sheet incumbents be the ones who are providing these services rather than the specialist, small companies that are ring-fenced and can't harm the traditional financial industry.
So to really kind of nail down the risk that you're seeing here, it's that you'll have these exchanges offer leverage products based on Bitcoin. So that means that traders will be able to put up Bitcoin as collateral and take loans or take leverage based on that Bitcoin collateral. And when these exchanges are linked to the traditional financial system, there's a risk that these Bitcoin leverage products crash because of the lower liquidity that Bitcoin has, the higher volatility that Bitcoin has, that just makes these leverage products riskier. So there's this risk that these Bitcoin leverage products crash and they affect the rest of the banks that are backing these crypto exchanges in a way that really hasn't been the case yet, because like crypto and traditional finance has been pretty segregated. So if a crypto company goes down, then that's kind of limited to that company. It hasn't really spilled over to traditional finance.
It has and it hasn't. Obviously the two banks that were serving the crypto industry are both gone, that were specializing in the crypto industry, right? And I do think that the two infected each other. I think crypto's gotten the blame for it a lot more than is due. I was grateful that NYDFS Commissioner Adrienne Harris clarified in her congressional testimony that the withdrawals of U.S. dollar deposits at Signature Bank were not greater proportionately from the crypto industry than they were from Signature's other customers. Like apparently Signature served a bunch of law firms in New York and real estate firms. They all at a proportionate level were withdrawing. So crypto definitely got more blame than it was due. But the broader point is still true, that banks have no business serving a fast settling liability customer base and turning around and taking those demand deposits and investing them in long-term assets. This is the classic borrow short and lend long business model of traditional banking. That works in an analog world for the most part. Periodically, you'll have banks go bust in a bank run. But in an analog world, pretty much it works because everything's really slow. Now we have online banking, right? Again, this has nothing to do with crypto. online banking, we saw a quarter of the deposits at Silicon Valley Bank withdrawn within the span of an afternoon. That tells you that things are speeding up, and so banks inherently are going to have to hold more cash. So, but you're right. As I relate that back to the crypto industry, you got it. Basically, we don't want crypto to infect the traditional banking system. The only quibble that I would have with your summary is that I think it already has. And it's because the regulators haven't done it thoughtfully. Those banks that served the crypto industry should have held 100% cash, because those demand deposits were that volatile. They could literally disappear in the span of hours as customers came to withdraw their funds. And so the only safe way for a bank to serve that industry is to hold 100% of the funds in cash, which is exactly what Custodia proposed and exactly what the Fed ironically said was more likely to cause a bank run. But that was before the other bank runs started. So, and in fact, actually, there is an even bigger irony. The head of supervision, Vice Chair Michael Barr, on the day of the Silicon Valley bank run, made an anti-crypto speech where he said, I'm paraphrasing, Federal Reserve supervised banks do not have bank runs because they're subject to prudential supervision. He said that as there was a massive bank run, right? So I think the world's upside down. They've got it, unfortunately, backwards. But it's pretty clear they don't have folks who really understand this, unfortunately. And so I think they're continuing to make the same mistakes, and they will continue to pay, unfortunately, for it as people lose money.
I think, if you're bullish crypto, you want it to become just part of the financial system, the broader financial system. I think, everyone here is just looking at blockchains and being like, they are meant to be financial infrastructure. Like they should be backing the entire financial system. But what I think, is an interesting point that you're making is that for that to happen, the requirements have to be a little bit different than what they have been so far. It's like you can't integrate crypto to traditional finance and keep the same way of working, the same cash requirements, collateral requirements, and so on.
Well, you want to ring fence it. You definitely have to integrate it somehow, but you want to ring fence it. That's the point.
And it's because it just, it has different characteristics. Like it's
correct,
more volatile, and so on.
Fast settling, and nobody's making more than 21 million Bitcoins. So there is no concept of a Fed put or a lender of last resort or a clearinghouse that can paper over a temporary solvency problem.
That's right. It's like if something happens in a kind of U.S. traditional bank, then the Fed can print more money.
Exactly, and will.
Right. You can just go and print more Bitcoin if something happens. Yeah.
That's the aha. Absolutely. What the Fed did with the banks to provide liquidity for the bank's underwater U.S. Treasuries, the BTFP portfolio, there's nobody who will be able to do that for Bitcoin.
That's a great point. I mean, there's no issuer of last resort. Like there's no lender of last resort. I mean, it's a blockchain. It's like a programmatic system. You can't just go to it and be like, hey, we need a bailout. What's Bitcoin going to do? Be like, okay, Bitcoin doesn't care.
Bitcoin doesn't care about any of this stuff. And, Bitcoin's fine. I just laugh. I was looking at one of the perennial critics of this industry who said the whole thing's a Ponzi scheme and the whole thing's going to zero over the weekend. And I just think, if that's what's driving the policy, boy, are they going to be proven wrong. And they can't look at Bitcoin right now and admit that they're already wrong, which of course we all know they are. But they'll be, they're just praying at this point that it goes to zero. And, the rest of us will just be stacking sats and hodling and laughing at the stupidity of all of this, this thought that it's going to go to zero. It's not going to go to zero.
Arch is a crypto asset management platform that helps you maximize returns with diversified and gas-efficient investment strategies. chasing yield doesn't pay off. Instead, the Arch Token Classification Standard, or ATCS, maps and classifies crypto assets to give you the best of Web3 in 7 products grouped by 3 categories: yield-bearing, index-style, and risk-adjusted portfolios. Learn more at the link on the description. So I think there's this difference between cryptocurrency itself, like the Bitcoin blockchain, the Ethereum blockchain, like all these things that will just keep running regardless of what happens. But then there are the businesses that are that have related products to crypto. So like the BlockFis, the FTX, the Coinbases. That some of them may and will go bust and go to zero.
Yeah, they will. But this is the not your keys, not your coins. If you own the base layer coins and you have self-custody them in a secure fashion, then you don't have counterparty risk. That's the beauty of it. You don't have to ask for permission. You don't have counterparty risk. You're not taking exposure that your bank might go to zero. The moment that you take your coins and deposit them into a BlockFi or a name like that, again, these companies have gone bankrupt, so I'll pick a name like that. But the moment you deposit your money into a lender like that, that discloses, I'll give them credit at least, they disclosed that they were engaging in rehypothecation with customers' funds. Most people probably have no idea what that word is. It's a big, long, scary sounding word. Most people don't know that what it means is that your Bitcoin are not yours, and your financial institution is taking your money and lending it out and pocketing the earnings, and you get stuck with the risk. And what we saw is that a lot of these lending companies failed because they were really running leveraged. And again, good riddance to all that. I don't think anybody should be playing this financial alchemy with Bitcoin. But it gets back to where we started in the interview in the very first place. This is the game that the big Wall Street trading firms know. And they're going to try to do it with Bitcoin too. That is absolutely a double-edged sword. I think it's a net negative for Bitcoin, just like all the leverage that came into the industry in the last bull market. It was a net negative, even at the peak of the bull market, because it put a cap on the price. And when the collapse came, the price went down even lower. We broke the historical trend that Bitcoin had always had higher highs and higher lows until the low of last year. We broke through the previous low last year. Why? It's because of this big leverage flush. It just makes the price more volatile. It makes the cost of capital for all of the players in the industry higher. And this is where I actually think if the US had done it right, we would have had regulated exchanges, and the FTXs of the world would not have existed. People would not have wanted to do business with a shady offshore exchange. They would much rather have done business with an onshore regulated one. And, you might say, well, gee, that's what EDX is. Okay, fine. But now we're back to the question of, wow, this is incumbents being green lighted while the startups, the crypto native companies are all being sidelined through regulatory enforcement actions. Wow. Yeah, no, it's again so frustrating and probably illegal in some cases. Yeah. Well, welcome to the United States. It's a favoritism. It's a favoritism game. I think so. I think some of the things are being tested in court to determine whether the agencies have overreached their jurisdiction. Right? I mean, we talked earlier about the SEC jurisdiction grab. If the courts determined that the SEC did not have jurisdiction to do what they did in terms of declaring things as security or declaring things an unregistered securities exchange, then yeah, that's an example of it. Got it. Yeah, and I guess again we'll have to just see how all of those things get litigated in court. It's such a shame that it takes years and years for these things to settle. And meanwhile, this industry just keeps going. Yeah, well, hey, the American voters voted this group in power right now. Well, let's see if they vote this group in power in the next presidential election. But the American voters did it. And we have divided Congress, right? So you've got when the judicial branch when the legislative branch is in divided hands, so we've got Republicans in charge of the House, Democrats in charge of the Senate, and then the executive branch is in Democratic hands, really when that kind of situation happens, which is the setup that we have now, the judicial branch is the place where things are going to move until there's another, a sea change on the election front. And the earliest possible time for that is November 2024.
We've mentioned these crypto lenders and exchanges that failed last year. How do you think they should be regulated? Because what I saw with last year's failures, there seemed to be this gray area in crypto of CeFi, of these companies that are centralized. They are custodying people's money and keys, but they're not they're not abiding by all of the necessary regulations to actually do that. And then there's kind of the Wild West of DeFi that's non-custodial and not holding people's money and not abiding by any regulations. And then there's just operations like yours, like Coinbase, who are really trying to do everything by the book. But it's to me it's like this gray area of CeFi where things go really wrong because there are people who are responsible for people's keys, for people's funds, and not really complying with the right regulations.
Yeah. So your original question was, what is the right regulation? I actually think the approach that the state of Wyoming took is right. Acknowledge that these are bearer instruments of finite quantity. And then let's back into what's the right way to respect the customer's property rights. Well, this isn't going to work like traditional securities, where a traditional security is owned by the depository trust company and you get an IOU from your broker dealer. We can do something much better and much more investor friendly. And that's what the state of Wyoming did. They said, let's apply the law of bailment to custody of digital assets. So if the customer elects a bailment, then that's the same law as valet parking for your car or a coat check. You're not handing legal title to your property over to the parking garage or the coat check, respectively. All you're doing is giving them temporary possession. And then it's basically what's called a directed trustee model. The trustee is a safekeeper that can do one and only one thing, which is keep your property safe. Hang up your coat or park it in the parking garage. They can't take it out for a joyride and pocket the money if they rent it out to an Uber driver, okay? But the way it works in the securities industry, it doesn't work that way. You can't get a true bailment because title rests with the depository trust company. You don't own the securities in your brokerage account. So it's pretty clear which is more fair to investors. The way that allows you to store your assets for temporary safekeeping without giving up legal title is far fairer, in my view, than depositing it in an IOU type situation of a leveraged counterparty, where if the counterparty goes bankrupt, it's get in line. And that's what we saw with Lehman, that's what we saw with MF Global, and that's what we're seeing with the CeFi companies in crypto that failed last year. It's really no different. Everyone's now learning the hard lesson, which some of us were trying to warn about for quite some time, which is that if you are a counterparty to a leveraged crypto company that rehypothecates assets, especially Bitcoin, then there's a very high probability that you're going to lose money eventually when that leverage flush comes. And that's exactly what happened. And, people were looking back then at 18% interest rates and thinking, gosh, I can earn all this yield. And I was warning at the time, you don't know that 18% is high enough. And it turns out in retrospect, boy, it sure wasn't. No way. And so it looked like those yields were high, but compared to what? You were taking on all this counterparty credit risk. It just didn't pay to take those yields that looked high because they really weren't on a true basis high yields. They weren't remotely compensating those customers for their for the risk that they were taking. And so again, this is why I think the Wyoming approach got it right. It's don't lend, don't rehypothecate, and do this in a non-lending bank that gives the customers a legal bailment over their assets. And so if the company went bust, then the customers don't have to line up as a general creditor. It's just like if the garage goes bust while your car is parked there, you are entitled to go get your keys and drive your car away. That car is not the property of the garage.
Super interesting. At least there's that example of how of one way to do it, which is a lot less risky than the way it's been done in CeFi before. And to start wrapping up, your thoughts on how crypto looks like if it doesn't get the US support? Does it simply move overseas, or does it stay kind of a fringe-like technology? I mean, can it become mainstream? Can it become this infrastructure for finance like we talked about if the US doesn't get on board?
Oh, absolutely. Sure, it can and it will. I like talking to non-US Bitcoiners because they have such a different perspective. And I personally spent some time in London about a month ago. Totally different perspective. Nobody was out there complaining about regulatory crackdown. In fact, they were eager because you see Europe and the UK actually green lighting these technologies and setting them up with regulatory requirements like segregation of customer assets from the institution's balance sheet. This stuff's not rocket science. It's right. And it's respectful of the property rights. So it's so funny. Yes, absolutely. The U.S. is definitely being left behind. But I like to analogize it to the taxi and limousine commissions with Uber. People are just going to walk with their feet. So try telling a 14-year-old who is, a talented computer scientist that they can't use any of these crypto technologies. Crypto is just code. Anyone can run it from their computer or their phone. Okay, so once you understand that 8 billion people in the world have access to it from a smartphone, there's no stopping it. And the U.S., all they're doing is shooting themselves in the foot. They'll be playing whack-a-mole with problems that will pop up because they didn't create a regulatory pathway. They didn't create a lit market. There goes the dog upset about not creating a regulatory pathway. I love it. It's funny where she started barking during this interview. Mad at the SEC.
Yeah, no, she has an opinion on all this. I tell you. I agree. In the end, this is the beauty of these technologies. They are global networks, so they can be used globally. They're permissionless, so anyone can access them. I think it's pretty much it's just such a hard technology to try to stop because it was made to be unstoppable. It was made to be uncensorable. So yeah, it'll be a tough job for the U.S. if it really wants to keep it out of its borders.
Absolutely, and nothing's stopping the base layer blockchains. They'll just keep going and probably thrive even more. Because what will happen is that people will just vote with their feet. And the more the U.S. tries to crack down and slow down the settlement speed of the traditional banking industry, the more especially the millennials and Gen Z who have never set foot in a bank branch or never written a paper check before, that generation is not going to want to go backwards technology-wise because those generations are comfortable with the concept of digital value, digital property. Ask someone in their 80s or 90s whether property can be digital, and I think the question is probably hard for them to understand experience-wise, because if they're not up to speed on the technology, of course, I'm making a generalization here, but this is not everybody, but you can see it in adoption rates. It's pretty much a straight line, with the highest by far being the Gen Z and the lowest being boomers and older generations. So there is something generational here, and it's unfortunate because the Gen Zs and millennials are not in charge. It's the boomers who are in charge, or octogenarians right now in the United States. And I've not seen evidence that they really understand what this technology is. And again, when they say it's all a Ponzi scheme, no, it's not. The concept that something that's digital and scarce has value is where they just can't wrap their heads.
I think it'll have to be a matter of time before the U.S. Is open and friendly to crypto, and maybe we'll have to wait until millennials or Gen Zs are in charge, or when everything is happening outside of the U.S. and the U.S. finally comes around. But in the meantime, it looks like it'll be for now the incumbents who are running crypto.
Well, welcome to the USA. That's the way it works right now. It's not exactly a fair market or a level playing field.
But at least we have founders, CEOs, entrepreneurs like yourself fighting for things to be done the right way. And to end things, Caitlin, how are you defiant?
How am I defiant? Oh my gosh, we're taking this very problem on in a very big way. So yeah, I think it's been publicly reported that Custodia Bank is pursuing litigation to enforce our rights in a court of law.
The best way to be defiant: take actions in your own hands. I love it, Caitlin. This was amazing. Thank you so much for this conversation. Good luck in your fight, and yeah, thanks again.
Appreciate it. Thanks so much.